It's your money. Keep more of it. Let's be honest, nobody enjoys paying taxes. It's that time of year when you look at your paycheck and you see a big chunk missing. You wonder where it all went. The government takes that money to pay for things like roads, schools, defense, which is all incredibly important. But here's the thing. The tax system is complicated. It's set up in a way that allows you to legally reduce the amount you owe. Not taking advantage of these rules is like leaving free money on the table. It's your hard-earned cash, and every single dollar you can legally keep is another dollar you can use to pay off debt. Invest for your future. Buy yourself a nice avocado toast without feeling guilty. This isn't about some shady, illegal scheme. It's about understanding the rules of the game so you can play to your advantage. Think about it this way. If you went to a store and the cashier said, "Hey, you can get a 20% discount if you just show me this coupon," you'd absolutely use the coupon, right? You wouldn't say, "No thanks, I'd rather pay full price." Alright, let's start with the absolute basics. The first major decision you make when you file your taxes. This is the choice between taking the standard deduction or itemizing your deductions. Think of it like a fork in the road. One path is super simple and easy, and the other requires a little more work, but could lead to a much bigger reward. The standard deduction is a flat, no questions asked dollar amount that you can subtract from your income to lower your tax bill. The government sets this amount, and it changes a little bit each year. For 2025, for example, a single person might get a standard deduction of around $14,600. It's the easy button for taxes, and a lot of people take it. The second path is to itemize. Itemizing means you don't take the flat rate standard deduction. Instead, you add up a whole list of specific eligible expenses that you paid throughout the year. These can include mortgage interest, state and local taxes, charitable donations, and significant medical expenses. You add all of these individual deductions together, and if the total is more than the standard deduction amount, then you choose to itemize. This is the key. You're trying to see if your personal list of deductible expenses can beat the government's standard offer. It's a simple math problem. Which number is bigger? So, how do you know which path is right for you? Let's look at deductions as they apply to you as a renter or a homeowner. Okay, so you've decided to see if you can beat the standard deduction. Let's talk about the big-ticket items you can use to build up your itemized total. Itemized deductions: mortgage interest, SALT, charitable donations, medical expenses. The heavyweight champion for most people who are homeowners is mortgage interest. If you own a home and have a mortgage, the bank sends you a form every year called a 1098. This form tells you exactly how much interest you paid for the year. For many people, especially in the early years of a mortgage when most of your payment is interest, this number can be huge. $10,000, $15,000, or even more. This single deduction alone can often get you very close to, or even past, the standard deduction. Next up on the list is the SALT deduction. This sounds complicated, but it just stands for state and local taxes. This includes the state and local income taxes that are withheld from your paycheck throughout the year. If your state doesn't have an income tax, you can deduct your state and local sales taxes instead. It also includes the property taxes you pay on your home and your vehicles. You just add all of these up. Now, there is a catch here. The government put a cap on this deduction, so you can only deduct a maximum of $10,000 per household per year from your state and local taxes. Even with the cap, for many people in higher tax states, hitting that $10,000 limit is easy, adding a significant boost to their itemized total. Another powerful and feel-good deduction comes from charitable giving. When you donate money or goods to a qualified charity, like the Red Cross, a local food bank, or a church, you can deduct the value of that donation. If you give cash, it's easy. Just keep the receipt or bank record. If you donate items like old clothes or furniture to a place like Goodwill, you can deduct their fair market value. It's important to get a receipt and be realistic about the value. Your 10-year-old t-shirt isn't worth what you paid for it. But these small amounts add up. If you're strategic and bunch your donations, you could make a significant contribution in 1 year to help push you over the itemizing threshold. Now we get to my favorite part of saving on taxes: tax credits. If deductions are like coupons, tax credits are like gift cards. A deduction reduces the amount of your income that is subject to tax, which is good. But a tax credit is so much better. A credit gives you a dollar-for-dollar reduction of your actual tax bill. So a $1,000 tax credit literally means you pay $1,000 less in taxes. It doesn't matter what your tax bracket is. It's a direct discount on the final amount you owe. There are a ton of different tax credits out there, but some of the most common and valuable ones are related to family and education. The child tax credit is a huge one for parents. It can give you a credit of up to $2,000 per qualifying child. There are income limits, of course, but a large number of families qualify for this. Then there's the Child and Dependent Care Credit, which helps you out if you have to pay for daycare or a babysitter so that you can work. These credits are specifically designed to ease the financial burden on working families, and you should absolutely claim them if you are eligible. Education is another area where tax credits can save you a fortune. The American Opportunity Tax Credit, or AOTC, is for students in their first 4 years of college. It can provide a credit of up to $2,500 per eligible student. A portion of this credit is even refundable, which means if the credit is larger than your tax liability, the government will actually send you the difference as a refund check. There's also the Lifetime Learning Credit, which is broader and can be used for graduate and professional development courses. Beyond family and education, there are also credits for things like making your home more energy efficient. If you install solar panels or energy-efficient equipment, you could be eligible for a credit. There's also the Earned Income Tax Credit, a major credit designed to help workers with low to moderate incomes. The point is, you need to actively look for these credits. Your tax software will usually ask you a series of questions to see what you might qualify for. This next strategy is one of the most powerful wealth-building tools ever created, and it comes with an amazing tax advantage. I'm talking about saving for retirement using tax-advantaged accounts like a 401k, traditional IRA. When you contribute to these accounts, you get to do it with pre-tax dollars. Money goes straight from your paycheck into your retirement account before federal and state income taxes are calculated. That lowers your taxable income for the year. Quick example. You earn $60,000 a year. You contribute $6,000 to your company's 401k. The IRS sees $54,000. You reduced taxable income by $6,000. At a 22% bracket, that's $1,320 saved in federal taxes. That's money you keep while saving for your future. Your 401k or IRA grows tax-deferred. You don't pay taxes on gains year after year. If your employer offers a 401k match, take it. It's free money. Common match, 50% of the first 6% you contribute. Contribute 6%. Employer adds 3% free. That's a 50% instant risk-free return. Not taking the full match is a huge mistake. No 401k? Open a traditional IRA. For 2025, you can contribute up to $7,000 a year, or more if you're over 50. If you meet the income rules, contributions are tax deductible. Anyone with earned income can use this. You're lowering your tax bill today and building a nest egg for tomorrow. It's the ultimate long-term strategy. Start early. If you have any kind of side hustle, drive for Uber, sell crafts on Etsy, do freelance writing, walk dogs, you have just unlocked a whole new world of tax deductions. When you are self-employed, even on a small scale, you are running a business. And businesses are allowed to deduct the ordinary and necessary expenses they incur to earn income. This is a game changer. Suddenly, personal costs can become legitimate business write-offs. That lowers your taxable profit from that side hustle. You're only taxed on what's left after expenses. So what counts as a business expense? The list is incredibly long. A classic example is the home office deduction. If you have a specific area of your home used exclusively and regularly for business, you can deduct a portion of household expenses. Rent or mortgage interest, utilities, internet, homeowner's insurance, a portion may be deductible. It has to be a dedicated space, not your kitchen table. A spare room or a corner set up as an office can qualify. Supplies are 100% deductible. Shipping boxes for your Etsy store, software subscriptions for freelance work, deductible. If you use your personal car for business, you can deduct actual expenses or take the standard mileage rate. For 2025, that might be around 69 cents per mile. Drive 1,000 miles, and that equals $690 deduction. A portion of your cell phone and internet bill can also be deducted. You just need to keep good records. The key is meticulous tracking. Don't guess at year-end. Keep receipts and records, use a spreadsheet or a dedicated app, and consider a separate bank account for your side hustle. We've covered a lot of ground, so let's quickly recap the game plan for cutting down your tax bill. This is your step-by-step action plan to keep more of your hard-earned money. First, understand the choice between standard and itemized deductions. Standard deduction, the simpler route. Itemized deductions, potentially more valuable. Do the math. Add up your potential itemized deductions, mortgage interest, state and local taxes. Remember the $10,000 cap, charitable donations. If that total beats the standard deduction, you found big savings. Second, don't forget tax credits. Credits reduce your tax bill dollar for dollar. Child tax credit, American Opportunity Tax Credit for college expenses, credits for energy-efficient home upgrades. Tax software is great, but know what you might be eligible for. Third, pay your future self first with tax-advantaged retirement accounts. Max out your 401k contributions and at least contribute enough to get the full employer match. It's free money. No 401k? Open a traditional IRA. Contributions grow for retirement and give an immediate tax deduction today. Make this habit non-negotiable. Finally, if you have a side hustle, treat it like a real business. Track every ordinary and necessary expense. Home office, mileage, supplies, software, document everything. Use a spreadsheet or an app. Keep labeled folders and stay organized. You're moving from a passive taxpayer to an active, informed participant. Knowledge is power, and it's money in your pocket. For more tips on how to save, invest, and build wealth, make sure to subscribe.